Good morning, and welcome to Market Wake Up. My name's Jordan, this is Jon, and you're in the one-stop shop to get everything you need to know ahead of your trading day. We're going to break down the macro mumbo jumbo, and we're going to be talking a little bit about Great British Pound, Japanese yen today, the correlation with bonds. You know, I like it. You guys don't, but you're going to learn. You're going to learn, all right? So stick with us. Let's get into the Market Wake Up. John. Happy Tuesday morning. How you doing?
Happy Tuesday. I'm doing really good, mate. How are you?
I'm well. It's been a decent day. It's been a busy day. I've been chatting to lots of people, making lots of decisions, including doing a little bit of research as well. So it's a good day. I'm always happier when I've been able to dive into a little bit of macro research, and I'm looking forward to be able to present it here today. So I'm feeling pretty good. Malcolm, good afternoon. Musclay, good morning. Paul, good morning. I hope you're all having a fantastic day. Thanks for tuning in. Make sure you've hit that like button while you're here. And let's dive in, John. We had a boring night last night. We knew that was coming, right? We knew yesterday was going to be a boring day. I've got nothing to add. It was boring.
Yeah, no, there wasn't a lot going on, was there? I mean, I was trying to watch to see how the markets were kind of playing the scenario at the moment. We've seen bonds falling, which is quite interesting. Bond yields are back up. If we look at sort of 30-year yields in the US as well, they're climbing again. So it's quite interesting scope in the markets at the moment, which is I'm trying to keep an eye on at the moment. But yeah, I was wondering if we would see the continuation of the metals like that we saw. Now they did close higher a little bit yesterday, but we started to see some kind of weakness coming back into those metals, but there wasn't like anything drastic or anything going on, was there really? It was very slow day.
That sounds like scraping the bottom of the barrel if I've ever heard it.
It is a little. It is a little.
Yeah, Andrew's popped in and said it's a busy week ahead. What are you up to, Andrew? You got me curious because well, actually, to be fair, macro-wise, it is a bit of a busy week. In particular, tomorrow, we've got obviously the Bank of Canada interest rate. A little bit later today, the sexiest thing we've got is Governor Bailey having a chat. I'll talk a little bit more on that in the big bite in a little bit. And then, as I said, Wednesday, we are going to have the Bank of Canada interest rate and the press conference. Then moving into Thursday, we've got all the flash manufacturing and services PMI out of all of Europe plus Great Britain. Then in the US a little bit later on. So we do spice it up a little bit later in the week. It's a slow start. We're rolling out of bed in the morning.
Yeah. I mean, I guess we were hoping that China would come in with some big stimulus and then it would be very big talking points.
There is a BRICS summit happening today.
There is.
So while there's nothing in the calendar, that's not to say something won't be affected. Because who knows what this BRICS summit can come up with
and lead to. could be something good, could be something bad.
Yep. Flip a coin, ladies and gentlemen. What do you reckon? Let's have a look at Freshly Squeezed. Let's get straight into it because there's not too much to have a look at. I'm going to bring up the charts here, but you know the game, John. VIX, where are we at?
I'm going to say I want to say higher. I want to say higher than 18.5.
Higher than 18.5 or 18.5? What's your
higher than 18.5?
No, come on. I need a number.
Okay, 18.5.
No, way higher, John. No, it is 18.8. It's
at 18. See, that wasn't that far off.
You're not far, but we are looking at 18.8 so far today. Andrew, I'm still waiting to hear back why your busy week is coming through. So I don't know if you're writing a book, but do it in the chat so I can read. I'm curious. The VIX, 18.84. Oh, there you go. Going to use an annual leave for vacation. No, speak to this guy about it. He's always on vacation. So it's steady. It's steady. We had a bit of a downfall in the VIX a couple of days on the Friday, and we're just kind of holding steady. Nothing really to report. Aussie dollars up 0.4, euros up 0.1, pounds up 0.17, US dollar CAD unchanged, US dollar Japanese yen up 0.1. Oh, geez, get it out. The XJO, the Oz 200, falling 0.7% today, which is interesting. It's the first down day in a little while. The DAX is up 0.3, the Nikkei is down 1.5, the FTSE is down 0.34, and the S&P 500 pre-market down 0.24. So a little bit of a sell-off in equities happening this morning. Nothing to write home about, but a little bit of weakness being felt. Coffee down 1.7%, gold up 0.5%. Finally, I mean, we're seeing a miscorrelation between gold and equities. This might be the first day I've seen the markets actually perform correctly, which is very interesting. Nat gas is down 0.9%, silver up 1.25. Absolutely smashed it. We spoke about this yesterday. I mean, we were trading silver in and around the 28s, and we constantly said how much we like the 32s. We're at 34. Absolutely walloped home on silver, which is fantastic to see. Sugar's unchanged, oil's down 0.3%, Bitcoin up 0.3%, Ethereum down 0.5%. Little movement in the yields. You're up 0.48 on the 10-year, up 0.4 on the 30-year. Looking at the Australian yields as well, 30 years up 1.2, the 10 years also up 1.2, seeing a bit of a sell-off in bonds, which usually leads to a bullish market in equities, which has not happened today. We are seeing bonds sell off, and we are actually seeing the XJO sell off at the same time, but we are seeing a bit of strength in the Aussie dollar.
Whew, yeah.
Sorry, everything there. There you go. Digest.
Really interesting shape of the markets right now. I think there's a lot of, the more I research into stuff, the more I feel like the market is still just mispricing everything, and I think, there's two ways you can look at it. The market can be wrong, right? The market can be wrong in history.
Opportunity.
And that's where I feel the opportunity is coming towards sort of Q4, maybe even Q1 of 2025. There is this, or in my expectations anyway, I feel like we're going to go into more of an inflationary environment. Because I was doing some little research on gold, and I was looking at sort of the dynamics between gold and, what do people usually accumulate when they've got more capital, right? They go and accumulate into, or they invest into certain assets, right? Stock market rallying, for instance, gold rallying, for instance. Gold's a great hedge for inflation, but it's also a great investment to have physical, right? Because if everything did go tits up, then there is the idea that they could sell those reserves and get some cash back, right? And then they'll be a little bit more liquid again. So this gold rally at the moment, I think it's just a very interesting dynamic, because I think it's kind of telling us what's the headspace of the market is. And gold's not even an overcrowded market right now. I was looking at the commitment of trade reports, and it's still not necessarily an overcrowded market when it comes to retail sentiment, right? Retail's still not really joining the fight when it comes to gold. So, yeah, just really interesting scenario at the moment. And it just makes the conditions very odd, in my opinion.
It is interesting, because we talk about gold going through all-time highs at the same time as the S&P 500. So we've got risk off and risk on both rallying at the same time. Yeah. I think that's where something like the commitment of traders could be interesting, because if you're seeing that there's not heavy retail involvement in taking gold higher, well, that would insinuate that the retail audience is buying up the S&P. Right, and buying up all of that, which is very, very interesting, because that would make sense on why they're correlating.
Yeah.
If that is true, having such a large discrepancy between retail and institutional is interesting. Because we're moving into territory where we've never really been before, because retail audience has become a powerhouse. It's not just like, mums and dads from home anymore because there's 40 million of them and they all put 100 grand in, right? So they are a powerhouse, the retail audience. We've seen that with the GameStop saga. We've seen that with the meme stocks. So it makes it really, really interesting to identify what's going to occur in certain events. Now, we know retail audience tends to be a little bit more shaky. It doesn't take much to scare them out, which is worrying if they're heavily involved in the S&P 500, because if they are the ones pushing up this run, they will be the ones to get out of this run, and that'll be mass selling, and that'll be a problem, right? Yeah. Now, if institutions are buying gold, that shows you where they feel.
Yeah, absolutely. I think one sort of area which I felt was quite interesting was the Russell. And the Russell was an area which was overcrowded by retail, and they were heavily long. And the Russell was one of the only stock markets yesterday that did close a little bit lower. It had rallied into sort of the highs and then just kind of come off them a little bit. Now, the Russell kind of rallied because of the idea that inflation was coming down and basically the Fed were going to cut interest rates, because the Russell's made up of kind of smaller companies, right? So they would benefit a little bit more from having sort of lower interest rates, because they would be able to sort of borrow more and be able to expand and things like that a little bit sort of on a lower end of the scale. So that was the kind of expectations there. I feel like they will be greatly impacted by inflation rising and the idea that maybe the Fed won't cut as aggressively. But this is a market right now where retail are very heavily long. So out of the stock markets at the minute, if I did want sort of exposure to stocks in the terms of me wanting to think about this bearishness that's coming, I feel like the Russell's a place to be able to do that.
Are you telling me you want to short the Russell, John? only flirting around the idea. I'm getting to the point. Are you telling me you want to short the Russell?
In my opinion, and what I am looking for is a potential short on the Russell. I don't have a technical setup for me yet, but that is an area where the market is seeing a lot of retail influence into it, and obviously I want to try and do the opposite of that. So when they become mass long into something, that is an area where we can typically see a market top. So all I'm saying is the Russell is showing signs that there might be a short-term sell-off coming. But yeah, that's just in my opinion. Everyone's going to come back next week and go, the Russell's broke all-time highs.
Yeah, and it happened with me with the S&P. I shorted the S&P. Woof, gone. So don't worry.
This is not trading advice.
Nothing we ever say is trading advice. But the good thing about this show is we're traders. We're not just analysts. So we don't just sit here and say, oh, this will do this because of this or this happened. We want to trade it. We want to make money on this. And that's why we think a little bit differently, because we actually want to execute on these positions. Saying that, let me transfer you, John, into the big bite.
Ooh, I'm ready.
Okay.
I'm ready.
Okay. We're talking Great British Pound, Japanese Yen today. We're going to talk about Great British Pound, Japanese Yen. Arguably John's favorite pair. He lives in Britain. He loves the Japanese yen. The man doesn't stop talking about the Japanese yen. So I thought I might just get him a little bit excited. Look how attentive he is now. Like he's here. He's here. I've got full attention from John. He's got his note. There you go. He's got his notepad out.
He got the pen today.
Great British Pound, Japanese yen. Now, this is a long-term play matched with a short-term seasonal pattern. So my intention here, and let me just state my intention, is I can see long-term growth potential. Okay. And my play here is other people are going to identify that long-term that long-term play potential in and around this seasonal play. So I'm not trying to capitalize on the long-term play. I'm trying to capitalize everyone else positioning for that long-term play. I'm playing the traders. I'm trading the traders, right? That's my intention here. That's a little elaborate. I know. I'm sorry. I've already scared you, but don't worry. It's going to be really, really simple. So we're going to start off actually having a look and doing a little bit of a technical analysis, okay? We've seen the Great British Pound Japanese yen when we did have the unfold. The Bank of Japan obviously changed their interest rates, and the carry trade unravel. We saw a large pull down. Now, compared to something like the US dollar Japanese yen, where we did hang around a little bit lower for a little bit longer, Great British Pound kind of held its own against it. It did actually want to straight away be climbing higher, lower highs, as you can see here. Let me go ahead and get my drawing tool. You can see we got all the way down here into the 180s, and then we even tapped back into the 184 the last time we come down. And if you were to remove this time here, we would be extremely bullish on this pair. Now, Jordan, that's the stupidest thing I've ever heard. You can't just remove a key price action. And I agree. But I do think what we're seeing here are a lot of investors see this as cheap. A lot of investors saying, hey, actually, yes, things did change over there. Yes, it was a massive reposition. But I actually see a discount here to capitalize on potentially some Great British Pound growth. And that's really, really interesting. And I wanted to dive into it. So the first was looking at the pound situation. Sticky. That's the one word, right? We spoke about it last week. The one word I had was sticky. Data's pretty good. Doesn't necessarily suggest we should cut. Doesn't necessarily suggest we should hike. Growth potential, not bad. Not bad, right? Like, it's just kind of sticky. It's like, okay, I think we might be evenly priced.
Yeah.
Agree?
I agree.
I'm glad you agree. I'm throwing on the bonds. You know, I like my charts. Here we go. This is where we get stuff. Yeah, get your notepad out. I jumped into the bonds, right? What we're having a look here is we've got the 10-year yield, the 30-year yield, and the 2-year yield. And then the red flat line is the Bank of England's interest rate as of right now. Okay. There's a few things I'm looking for here is where the long-term yields are pricing growth potential for the UK and where the 2-year yield's heading. We've spoken a little bit about this last week. The 2-year and the 10-year are heavily correlated right now. All right, we're sitting in here. This is the two blue lines there, and we are about 84, 85 basis points away from where the Bank of England currently sit. So in the near short term, they are still forecasting this to come down, but not aggressively. The 10-year yield still sitting at 4.1%. We're sitting at the moment at 5%. 10-year difference, it's not too worried. What's interesting is the 30-year yield's actually priced higher. So the long-term investors, when it comes to the pound, are already thinking, hey, I think this is short-term pain, long-term gain. 30 years from now, I don't think we're talking about this. I think we recover and we're actually in a much better position. And that's what I'm reading from this data, okay? So I'm seeing that investors long-term actually see bullish potential in the pound. And I like that. Right? Now, we change our interest to the other side of this pair because we trade FX. There's two pairs to the Japanese yen. Holy, how long do you have? We can talk about this all day, right? But I'm going to try to do this short and sweet. I believe, not financial advice, I believe the Bank of Japan will continue to hike interest rates. They are forecasted to continue to hike interest rates marginally, not much. But I do believe the data in which we're witnessing will continue. I do believe it will continue. Macro analysts around the globe are predicting weakness in the Nikkei. I'm giving them the middle finger and saying, you're wrong. I know.
I like it.
I'm going against every other person that gets paid $73 million a year to say up or down. They've said up. I'm saying they said down. I'm saying up. I'm just contrarian in that way. The future growth outlook for Japan is actually pretty good. Now, if we also compile that with a bit of uncertainty in other markets, it adds to that growth potential in Japan, in particularly local markets. Looking at bonds, looking at the Nikkei index, having a look at those local stocks, I do see growth potential. When I go to this bond chart, look at the difference, okay? Here is the Great Britain's picture, right? Yep. All the bond yields and the interest rate. Here's the Japanese. It's a little bit different. It's a little bit different. What we have is the Bank of Japan interest rate, right? This flat purple line down the bottom, which was just sitting at nothing for a very long time, actually negative. Then we've got our 2-year, which is the red line. We've got our 30-year, which is, this purple line. And we've got our 10-year, which is this blue line here, okay? Look at the difference between the 30-year yield compared to the current interest rate. That tells me that bonds are not in demand. No one's buying bonds because the yields are running through the roof. No one's buying bonds, right? And that's super, super interesting because that usually means everyone's buying the Nikkei. If you're not investing in bonds, it means you see growth potential elsewhere, risk on assets. If Japan and Japanese investors see growth potential in risk on assets, I don't want to disagree because I see the growth outlook and potential. And I think it's really, really interesting. Now, what I also found interesting is if I throw on the Nikkei index on top of this chart, the correlation that we have with the 30-year yields, they're pretty good. They're pretty good. They're not sexy, right? They're not they're mirroring each other, but the overall direction in which they move, I actually quite like what we're seeing there. I quite like what we're seeing there. So I've had a quick look through. Growth outlook for Japan, positive. Very positive. Just for understanding, the difference between the 30-year yield and the Bank of Japan current interest rate is over 200 basis points. 200 basis points. 2%. Right? We usually hike. What? The last hike, what was it? It was 0.1?
Yeah, like that.
Yeah, it was, exactly. 200 basis points, the investor outlook, the sentiment. What I want to capitalize on, and now I'm going to have to change screens here, so bear with me for just a second. Blank screen. What I want to capitalize on is this. Over the past 25 years, there's one area you're looking at here, which you go, I want to buy there. It stands out. It stands out. It really, really does. Late October, which we just happened to be in, John. Late October, all the way into December if you want to, but I'm going to stop at late November, right in here. This number is wrong. Okay, I can get it a little higher if I play with the dates, but 72 will do. 72% will do. What we're seeing here is a incredible seasonal pattern on the Nikkei index. And what we have also done, I can't just quickly change over. What we have also done is identified a correlation between the 30-year yields and the Nikkei index. We know that if the 30-year yields are climbing, it means bonds are falling. And if bonds are falling, bond yield is rising. Trying to attract more interest into international investment. And then if we throw the Nikkei up against, I'm going to flip back. I know this is a little bit heavy. Stick with me. We're going to flick back. If we throw the Nikkei up against the JXY, which is the Japanese yen index, we have an inverse correlation. Inverse correlation. We're forecasting Nikkei strength because Japan's telling us to. The bond market is telling us to. If we're forecasting Nikkei strength, we should be forecasting some kind of weakness in the Japanese yen. And if we're looking for weakness in the Japanese yen, let's go to somewhere that's sticky, that can hold its value. Great British pound, Japanese yen. To sum it up, to the moon. But to sum it up with a bit of technical analysis. Now, this is actually broke out today. I was looking at this morning. This is twice it's happened to me. The little pincer movements that you love so much, John, has happened. And we've just broken out here on the daily today. All right, broken up to the upside. Now, we've got a bit of free reign. We've got a little bit of free reign in technically to get up. We've got this mess here, okay? But if we can get in and around that, I see a macro world where we have the strength to get through. If we compile that with what we're looking at for a seasonal pattern, which won't end till late November, which gives us this time frame, I think there's a lot of room for growth here. There is your Great British Pound, Japanese yen, big bite.
I like it. I like that a lot. My only concerns, is the risk option, but that is the problem with that is we don't know when that risk's going to come in or if it comes in, and that you can't sit around and wait for it to happen because you just don't know. You just don't know. So, but that would be my only concern with this, like, because we know that the market's going to shift again if it does get a little bit tasty out there.
That is exactly why I'm taking a long-term approach into a short-term trade idea. This gives me a month's exposure. Month and a half's exposure compared to trying to trade it for 30 years. It gives me the long-term idea into the short-term place. I agree. I wholeheartedly agree.
Yeah. And there's a sticky point for me around about the 197s, but other than that, I think if we try and clear above those, then that could be something interesting, because like we kind of had the conversation last week, pound's actually the best of a bad bunch, I feel. It's not necessarily seeing the aggressive, moves lower. I mean, we had the inflation come out, and inflation moved lower, so everyone was like, "Oh, sell pound," inflation's lower. But that was quickly sort of retreated because retail sales came out, and then it was better. So it was like, well, hang on a minute, So we have to look at the bigger picture, because the little bits in between a trend, obviously, are the bits that macro will move. Right, this sudden piece of data we'll get out will move markets in a certain way, but you have to look at the bigger picture. I still feel pound is the best out of a bad bunch. Like we've said, well, obviously, I think the dollar is the best. It was very undervalued, and we've seen what's happened with the US dollar recently. The pound isn't necessarily a million miles away from that. Obviously, the GDP growth is nowhere near, but if you compare it to other markets globally, then it's actually not doing too bad. Interest rates are a lot higher than other places. The inflation rate is in an okay position now. Obviously, they're going to want to try and prevent inflation from just falling off a cliff, which is something that's happened in Canada. So there is obviously, things that we need to consider, but I do like this a lot. We've obviously seen the shift away as well. There was a lot of selling of the Japanese yen. There was a community trader report signal at the sort of middle of September for a short Japanese yen, and that has kind of continued to play out. Hedge funds selling yen again, and I think we touched on it a couple of months ago, probably a month ago, where we talked about, is the carry trade going to come back? That carry trade unraveled quite quickly, but was it going to come back? And we kind of said that there is a good opportunity of it coming back. So I feel like obviously it's not as aggressive, but if you look at the price action, it's very similar to the price action that we had when we were slowly climbing for the portion of
a carry trade is really hard to do. So a carry trade, like, you need to be in it for a minimum of a year, right, to get your interest, to get the differential, and you need price action to be stable. And I can't see a world where Japanese yen, because the growth outlook is positive and the growth outlook elsewhere is negative, while the current rates pose attractiveness, you need to also ensure that pair doesn't drop in value by a percentage larger than what you're going to earn, right? So I would find it hard to believe a carry trade will come back into play, because I think the risk is too high. I mean, even if you manage to get a rate differential of 3% over a year, so you're playing to get that 3% back, any type of movement against you, which is likely given the current growth outlook, is going to dig into your profits. You might sit there for a year to make 0.6%, and it's just not sexy.
No, not as sexy. But I like this a lot. I mean, the seasonal play on the Nikkei is quite interesting, isn't it? I would that is something that I would be very, very interested in if it were to set up. So interesting with that. How would you go about getting involved in something like that if it was the Nikkei? Looking at the market, it's down 1.5% at the moment. Would you be looking for some kind of technical breaks higher?
Yeah, I wouldn't necessarily want to trade the Nikkei itself,
right?
Which
want to get exposed in the yen.
I would try to get exposed in the yen. I'd try to limit my risk to the Nikkei, just because I want to limit my risk to all equity
Stock
assets right now.
Or any stock
Yeah.
market you want to avoid.
That's, if we're in normal conditions, I'll take the Nikkei, and I trade the Nikkei quite often. Like I don't mind being invested in trading the Nikkei. It's just right now my global risk outlook does not match that portfolio.
That's fair. Interesting one. I enjoyed that today.
Yeah, good. I'm glad. Guys, I hope you enjoyed it too. If you did, let us know. We're going to be back tomorrow to do it all again at 8:30 a.m. British Standard Time. Ahead of today, just be very careful around Governor Bailey having a chat and keep your eye on the news with BRICS. We've got no idea what they might announce or what they might do. It will move markets, so just keep an eye on that as well. Without further ado, John, it's been a pleasure. We'll see you guys tomorrow to do it all again. Cheers.